So now we've sort of mapped out the different possible combinations of risk and return on the capital allocation line. We now know that these are going to be linear combinations. So the outstanding question is then, what portfolio will the investor choose? And we answer it in the same way that we have begun to answer questions about portfolio choice, which is using a utility function. So let's actually consider all possible values of the allocation to the risky asset Y, up to 100%. Remember, technically it could extend even farther if we want to borrow at the risk-free rate. But let's just for now look at allocations to the risky asset anywhere from 0 to 100%. Let's compute the expected returns and standard deviations of the portfolio using those same inputs that we were initially considering. 15% expected return to the risky portfolio, 22% standard deviation for the risky portfolio, 7% risk-free rate. And let's bring in our utility function that we previously considered over expected returns and standard deviations of returns with a coefficient of risk aversion of 4. Why 4? Well, why not? It's an arbitrary example, but remember we can actually fine-tune what the coefficient of risk aversion is for a particular investor given their preferences that we might elicit through surveys or behavioral observation. Now all we do is just given these combinations of expected returns and standard deviations for the complete portfolio, plugging them into the utility function, we just compute the utility scores. And we just go through these and see which one has the highest value, and it looks like it's this one. In other words, when we allocate 40% to the risky asset and therefore 60% to the risk-free asset, that maximizes the utility for this investor with a coefficient of risk aversion of 4. And if we were to plot out these utility values now from the prior table, except now putting the allocation to the risky asset on the horizontal axis and utility on the vertical, we would get this sort of convex shape, which shows us that there will be a single maximum, and indeed, of course, that maximum is at 40%. So that's sort of the graphical illustration of how we can get the optimal allocation for an investor given their risk and return preferences for a portfolio that contains both a risky and a risk-free asset. Now let's think about it rather than graphically, let's think about it mathematically. This is essentially an optimization problem, right? So how can we solve optimization problems? Well, we can take derivatives. What is our one variable that we can control? Remember, we can't really control the rates of return on anything. Those are set by the market. We can simply control how much we allocate to each of these two assets we're considering, which is the weight that we'll assign to the risky asset, which will then, of course, determine the weight that we assign to the risk-free asset. And the good news is that we can essentially then express our utility function. Remember, it's in terms of the expected return and standard deviation of the portfolio, and we've already derived the mathematical formulas for the expected return to the portfolio as a function of our allocation to the risky asset of y. Remember, it's the risk-free rate on everything plus y times the risk premium on the risky stuff. And then remember, in the utility function, we subtract 1/2 times a times the variance of the portfolio. And we have an expression for the variance of the portfolio as well. It's just if our standard deviation was the allocation to the risky asset times the standard deviation of the risky portfolio, well, now it's going to be the variance or just that term squared. So we essentially plug in our formulas for expected return and portfolio variance, or I should say minus 1/2 times A times portfolio variance. Then we simply take a derivative with respect to y, set it to 0, and that will give us a solution. We can actually check whether this is going to be a maximum or a minimum, but given what we've seen graphically, we know it's actually going to be a maximum. So remember, taking a derivative of, let's say, the first part with respect to y, well, that's just going to be the risk premium, and taking a derivative with respect of the second part with respect to y, well, it's going to be, let's see, 2 times y times 0.5 times a. So I guess the 0.5 and the 2 will cancel, so you'll just get a times y times sigma p squared. And if we're solving for y, we're going to set this whole thing to 0. We can just move y times a sigma p squared to the other side of the equation, then divide both sides by a sigma p squared, and that'll tell us that y is actually equal to the risk premium over a times sigma p squared. So this is our optimal allocation to the risky asset, and you can see it's just in terms of the givens to the problem, the expected return to the risky asset, the risk-free rate, the coefficient of risk aversion, and the standard deviation or the variance of the risky portfolio. So now let's say that we have still the same setup in terms of expected returns and characteristics of the risky and risk-free portfolios. And now let's say that we're going to do this for an investor with coefficient of risk aversion of 2. Well, we just plug that in, and we see that now our optimal allocation to the risky asset is 82%, 82.6. And then, of course, that means that the remainder of about 17.4%, that's going to go into the risk-free asset. And this makes sense because, remember, in the prior example we determined that for an investor with a higher coefficient of risk aversion of 4, that investor would want to hold only about 40% in the risky asset. So an investor with a lower coefficient of risk aversion actually wants to hold more in the risky asset. Now, how can we express the idea of utility across different possible combinations of portfolio characteristics? In econ, we've come across this idea before of indifference curves. In other words, shapes in the expected return standard deviation space for any point along which we have the same level of utility. So let's say that, remember, a utility function decreases in standard deviation, increases in expected returns. If we can adjust both parameters appropriately, we can essentially draw values such that the utility anywhere along this curve is constant. You get higher standard deviation, but you get higher expected return, and in a combination such that your overall utility actually stays constant, which is why we call them indifference curves, because anywhere along that point, your utility being constant makes you indifferent. And then, of course, anywhere higher up along these curves means you have higher utility, because for any level of standard deviation, you get a higher expected return, let's say on indifference curve B relative to indifference curve A. So curve C is the best, B is second best, A is third best, and we can keep drawing curves. But why are we considering this? Well, because we can actually show another way that we can sort of arrive at the same mathematical optimal result using the combination of indifference curves and the capital allocation line. So for now, we just need to note that an investment on any higher curve is better than an investment on any lower curve, just because the utility on a higher curve is by definition higher than that on a lower one. So now let's actually compute some indifference curves, specifically these four, targeting four different levels of utility. Remember, we're essentially saying, what does your, let's say, risk premium have to be such that given any level of volatility, your utility is constant. In this case, let's say your utility is constant at 0.07. Well, here are the risk premiums you would have to have for each level of volatility to make that true. Here are the risk premiums you would have to have such that at each level of volatility you have a somewhat higher indifference curve with a utility of 0.078. Here are the risk premia that you would have to have such that your utility is higher still at 0.086. And finally, here's the one that's highest of all. These are the risk premia you would need for each level of volatility such that your utility is constant at 0.094. Now, if we look at all of these possible values we can generate, which of them actually matches a value that we can achieve on our capital allocation line? Remember, the capital allocation line is another way to sort of map volatility to risk premium, because now we have that linear relation. For each additional unit of exposure you take to the risky asset, you get a certain amount, that same amount of risk premium. So the more you take in terms of exposure to the volatility of the risky portfolio, the more you get in terms of risk premium from that risky portfolio. And we actually see that there is only one tangent point where the utility indifference curve is equal, the expected return on the indifference curve is equal to the expected return on the capital allocation line. Thinking of it graphically, essentially what we've identified is this point at utility of 0.086 in the blue dashes that is tangent to the capital allocation line. In other words, it has, for that same level of, or for that level of volatility, the same risk premium, or I guess the total expected return to the portfolio of 10.28%. And that's about the best that we can do. Why is tangency the best that we can do? I mean, technically, we could settle for this point, right? Here's an equivalence between expected returns on the capital allocation line and this indifference curve in the line blue. But remember that this indifference curve, I guess this would be the 0.078 utility indifference curve, this one is lower. So we actually wouldn't want that because we can go a little bit better, a little bit farther up the capital allocation line, and get on a higher indifference curve. And we can keep doing that. The highest indifference curve that we can get, the one that still touches the capital allocation line, is the utility curve in the blue dashes, the 0.086 utility indifference curve. We can't go any higher. We can't, for example, reach the 0.094 utility indifference curve in the black line here, simply because it just never touches the capital allocation line. Remember, the capital allocation line represents simply what is possible in terms of portfolio combinations. We just can't make a portfolio work that would give us this risk-return trade-off. So the best we can do is find the point of tangency with the highest possible indifference curve. And that happens to be this one with utility of 0.086 at an expected return of 10.28%. So this is another way that we can sort of graphically visualize the same sort of optimization problem, just now connecting the idea of utility to indifference curves, and therefore to optimality. Now, we have sort of been making this implicit assumption that I said was a little weird, that our lending rate is actually the same as our borrowing rate. So if we want to invest more than 100% in the risky asset, we can, and just keep going up sort of straight. Well, I mean, if we're not actually a sovereign government with the same sort of credit as the United States, we probably can't do that, because our borrowing rate is going to be higher than the risk-free rate, which the US government can borrow at. Indeed, it can be substantially higher. For example, we can think of the rate at which individuals may borrow. A credit card may lend to an individual at about 20% a year. A brokerage may lend to an individual at about maybe 10 or 8% a year. So in an environment where the risk-free rate is about close to zero, well, that's a substantial difference. A borrowing rate that is far greater than the risk-free rate. But we can actually take this into account. All we need to do is just sort of introduce a kink to our capital allocation line to account for the fact that when we borrow, we're going to have to pay more than the risk-free rate for our borrowings. In other words, our risk premium is actually going to be lower because it's not going to be the expected return to the risky portfolio minus the risk-free rate. It's going to be the return to the risky portfolio minus whatever our borrowing rate is. And indeed, this is actually what happens when, for example, somebody in a retail brokerage will borrow on margin and buy risk assets. They will actually be somewhere on this kink of the capital allocation line. And, well, they may find themselves in an unfavorable situation if the kink is actually steep enough. So when it comes to any allocation to the risky asset below 1, we're still using the risk-free asset because we can definitely invest or lend at the risk-free rate. It's just that when we want to allocate more than 100% of our portfolio to the risky asset, here we will borrow at a rate above the risk-free rate. So this is a pretty simple way to fix that somewhat unrealistic assumption that we can borrow and lend at the same rate. So what do we know about the optimally risky portfolio? Well, remember, we talked about how the slope of the capital allocation line is the Sharpe ratio. And the higher the slope, essentially the better the possible portfolios we can construct, right? Because remember, our optimal portfolio is tangent to the capital allocation line. The higher the slope of our capital allocation line, the farther up these indifference curves we can potentially move, the higher one we can find ourselves tangent to. So one powerful insight from all of this math, then, is that what we really want to do is we want to create a risky portfolio with the highest possible Sharpe ratio. That's going to give us the most steep capital allocation line slope, and that will get us on the highest possible indifference curve, give us the highest utility over expected returns and portfolio standard deviation. So this is why the Sharpe ratio is of such sort of key interest to portfolio managers, especially for mutual funds. In hedge funds, there's a bit of a qualifier we have to make because the Sharpe ratio is really particularly good for normal distributions. For non-normal payoffs, which hedge funds often have, it may be less good, but generally for portfolio construction, we will still think about maximizing the Sharpe ratio because of its powerful connection to maximal utility. The other important thing that we can get out of the Sharpe ratio is just sort of a comparison of risky assets one to another, done more or less properly, especially if all we care about is the expected return and the standard deviation of returns. Let's say that we've got two assets. One has an expected return at standard deviation like so, and another like so. So we ask ourselves, which asset is better? Well, what does better mean anyway? Well, one thing we can say is maybe a trade-off between expected return and standard deviation. If we just take the ratio of those, for asset 1 it'd be 1.67, for asset 2 it would be a whopping 3. So does that mean that asset 2 offers a better risk-return profile than... Does asset 2 offer a better risk-return profile than asset 1? Well, if those are your only two options, yes. But if there is a risk-free asset, then you can actually bring in the idea of a Sharpe ratio, because remember that ratio actually requires you to know what the risk-free rate is, and then you may come to a different conclusion. So the Sharpe ratio of asset 1 is actually 0.5. In other words, the risk premium is 3%, standard deviation is still 6, ratio is 0.5. For asset 2, the risk premium is actually -1. Standard deviation is, well, 2, so the ratio is -0.5. So that means that, based on the Sharpe ratio, asset 1 is actually significantly better than asset 2, and indeed, because asset 2 underperforms the risk-free rate, on average, we would probably never really want to invest in asset 2 at all, because we can actually get a higher expected return with lower volatility, which is to say 0 volatility, if we just hold the risk-free asset. So the Sharpe ratio really represents two important ideas. First of all, your risk asset has to beat the risk-free rate and expectation. In other words, it has to have an expected positive risk premium, like asset 1, and unlike asset 2. And for any given level of risk, the portfolio that has the highest risk premium, therefore the highest Sharpe ratio, is the most desirable. So we can construct these capital allocation lines for any combination of risk-free asset plus risky asset. But now let's consider sort of a special one, which is to say the market portfolio. Now, the market portfolio is essentially a weighted portfolio of all assets in the market. We can think maybe market cap weighted, or we can think equal weighted. And what this capital allocation line would be is a capital market line. And indeed, a lot of what we talk about in finance will be based on the assumption, but an assumption that is reasonably backed by data, that the market portfolio, as the broadest and most diversified portfolio, will have the highest possible Sharpe ratio. Now, we'll talk about diversification in a little bit, but intuitively, if we have all of these correlation terms, as we do in the equation for the variance of a two-asset risky portfolio, so as we expand it to multiple risky assets, we'll have more and more correlation terms. Some of them will be quite low, so the more assets we introduce, potentially the lower the variance of the portfolio will be, especially if we can find some negatively correlated assets. So if it's true, if the market portfolio has the highest Sharpe ratio, or even if not, if we can find whatever portfolio generally has had the highest Sharpe ratio, then a capital allocation line through that portfolio and the risk-free rate is going to be steeper than any other capital allocation line by this previously rehearsed argument that really, to maximize the slope of the capital allocation line, which is the Sharpe ratio, we just want to select the risky asset with the highest Sharpe ratio. But then that actually leads us to the somewhat startling conclusion that if the market portfolio has the highest Sharpe ratio, and that's the capital allocation line everybody wants to be on, that means that really everybody is going to want to hold the market portfolio as their risky asset, just in different proportions to the risk-free asset. The intuition of it can be expressed graphically here. We've got many different capital allocation lines, several risky portfolios with different standard deviations and expected returns. But if the market portfolio has the highest Sharpe ratio, and therefore the highest ratio of expected return to standard deviation, as we've drawn it here, it's got a higher return than portfolio 1, and a higher but not as marginally higher standard deviation than portfolio 1, and it's got a higher return than portfolio 2 and actually a lower standard deviation than portfolio 2. Therefore, graphically, it's got a higher Sharpe ratio than both. Then this is the capital allocation line that everybody would want to be on, because no matter what their utility curve, if it puts them over here if they're more risk averse, or if it puts them over here if they're more risk seeking, they're going to be able to get on a higher indifference curve if they use this capital allocation line than if they use any other. And of course, the only way to get on this capital allocation line is to hold this particular risky portfolio, the market portfolio, and therefore everybody, according to this version of portfolio theory, should hold the same market portfolio. Now, this may seem like a bit of an overclaim. Is this actually true? Well, if you think about investment funds, how many investment funds would have, let's say, the S&P 500 ETF or a S&P 500 type mutual fund in them? Well, quite a few. If we expand it to maybe the Russell 3000 in terms of maybe all US stocks, the coverage or overlap would be even greater. So in other words, it actually empirically does seem to be the case that many investors will in fact hold the same portfolio of risky assets, though perhaps not fully so, because their weights might actually be different. Not everybody holds all of the Russell 3000, but a lot of people hold the S&P 500. And if the S&P 500 is primarily made up of a few big firms, almost everybody holds, no matter what their mutual fund product is in their, let's say, retirement account, everybody will hold those firms. So this is maybe not ironclad reality, but this theory is actually surprisingly close to the truth. So historically, it's good to think about what the Sharpe ratio actually has been of the market, about maybe 40 or 0.41. So in other words, for every unit of standard deviation you take and every unit of risk, you get 0.41 units of risk premium for it. We can see that generally it oscillates fairly wildly. If we smooth it out with a 10-year lag, it oscillates a bit less. And if we just sort of take a unitary average, we get a little bit less than 10% of market risk premium. Remember, the number that we talked about in the historical record at the outset of this lecture was about 8.4% in risk premium. So this is sort of the playing field one may expect if they actually hold the market portfolio. This is about the Sharpe ratio, the slope of the capital allocation line they should expect. And this, long run average, may be the best guess, absent some fancy mathematical models of future expected returns that one may have for the expected risk premium for bearing that risk. So that's annual. What about monthly? Well, we can see that there's even more volatility. Even the sort of 3-year smoothed risk premium is actually quite volatile, which I guess goes to show that the higher the frequency, potentially the more volatility within each observation. Thanks for listening. Next time we're going to talk about how to actually construct a portfolio down sort of to the very foundations, how to actually combine this mathematics into weights on both risky and risk-free assets.